Builders and Innovators Conference, the 8th year, I believe.
The 8th year.
So tell us a bit about the conference and also how it's evolved over those sort of 8 years.
Sure. This is, since 2012, an event we have each year out here in Santa Barbara where we bring together about 125 or so founders or entrepreneurs who are building big businesses, all different types of businesses. Some are more progressed in their life cycle. Some are newer businesses, but interesting ideas. Give you an example, you go back to 2012, that first year, two of the companies that were here as young companies were Dropbox and Uber. So it gives you a sense of the life cycle a little bit, but these are interesting businesses. They're changing the world, changing the way we do things. They're hiring people, adding jobs, and I really come away from this event every year energized and really feeling good about the fact that with everything going on in the world, the innovation and entrepreneurial culture in the United States that's so important for job creation and growth is alive and well. And we really spend some time trying to get to know some of these companies and allow these different entrepreneurs to connect on their experiences and see how they can grow, what they can learn to help them move forward.
Well, we're definitely going to dive into some of those themes that you're alluding to there. But first of all, we were here together a year ago. This is essentially a year since you took over as CEO. Do you feel like the first year was a year of transition for Goldman Sachs?
Well, it was certainly a new job for me, and I would say, just thinking about the fact that we sat here a year ago, it certainly went quickly because it feels like I was sitting here with you just 10 minutes ago. But I think back to October last year, and one of the first things I did when I started as CEO last October was to take a group of people inside the firm and get them focused on how we face clients as an organization. And we started talking about this concept of 1GS, and we've always been a client organization, but there's really been an opportunity over the course of the last year to always think about how we can improve, how we can do better, and how we can really think about making sure that our clients are getting the best of Goldman Sachs. And so I feel like we've accomplished a lot on that in the context of the first year. And I also feel good about the fact that the investments that we're making to kind of evolve the organization and move the organization forward are really progressing nicely. We've got a great management team that's really come together on a medium and longer term plan. And so I feel like for a first year, that feels pretty good.
The investments, you talked a lot about the earnings call, which came out a couple of days ago. Those earnings did miss expectations. Revenue was down 6%. And you spoke on the call about the impact on the short-term earnings that some of the investments in new areas, Marcus, Apple Card, transaction banking are having. I think you said $450 million worth of those investments made this year. How long are you asking investors to stick with you, to give you faith before those investments pay off?
Well, what we're really trying to do, and I think it's what we have to do, I don't think we have a choice, is we're focused on our existing businesses, and we're also focused on making investments to evolve the organization and move it forward. And we think about these investments as medium and long-term investments, and we've tried to be very transparent and clear that as we build these new platforms, we're making progress, but these are things that are going to take a number of years to really materialize their potential. And I talked on the call a little bit about how we built an asset management business going back to the 1980s. And if you think about the asset management business that we have across the world today, I look back at our investing platforms, which we started building in the 1980s. Goldman Sachs is celebrating its 150th anniversary, and we're building businesses for the long-term value of our shareholders in the firm. And so this will take some time. We're trying to be as clear and transparent as we can, but there are milestones that we're excited about that we crossed this year, and we feel like we'll continue to make progress.
Were some of these changes and investments ones that perhaps could have been made a little sooner by your predecessor?
Well, I think that some of these started with my predecessor. If you look at what we're doing from a digital banking perspective, that started with my predecessor. But these things take a long time to progress and to really come to fruition. And what we're really focused on now is looking at our clients, the different clients we have around the world, corporations and governments, institutions and individuals, and saying, how can we do more as Goldman Sachs for those clients and really make the investments to broaden it out. And so I feel good about the course that we're on and good about the progress we're making.
In a meeting that was reported by Bloomberg, your deputy, John Waldron, supposedly said that the old management was slow to make changes. Do you disagree with that? I
think the new management is very focused on making the changes to move us forward from here. And to be honest, with everything that's going on, I don't have a lot of time to look back and debate what woulda, shoulda, coulda in the context of where we've been. Goldman Sachs has performed very well over a long period of time, and we're working hard as a management team to take the firm forward.
On Marcus, you were at an event in June. My colleague Hugh Sum was there, and you said, quote, "We're getting absolutely no credit from anybody in the investing community about it yet. If we were out in Silicon Valley and made 20% of the progress we've made, we'd get a lot of credit and people would be throwing money at us." Are you annoyed that public markets haven't given you more of a valuation multiple, more of a reward for what you've done and what you've innovated?
I'm not annoyed. I just expect and understand that in the context of a large public company like this, it's going to be a prove it on this. And I said this on the earnings call, but I feel very good about it. And I think the team's executed incredibly well. Over the last 3 years, we've built a digital bank with $55 billion of digital deposits, with $5 billion of loans, 4 to 5 million customers, a brand new credit card platform, and have launched a card with Apple. I feel like that's pretty good progress over a short period of time, and we've invested over $1 billion to get that. Mm-hmm. But if you looked at all that, would you invest $1 billion to get that? Absolutely, you'd invest more. So again, we're building for the long term. I feel good about the progress that we're making. Would I be pleased if the world recognized it sooner? Sure, but I don't expect that. I know that we have to deliver, and the onus is on us to deliver over time for our shareholders, and I'm confident we will do that.
You said on the call that the launch of the Goldman Sachs Apple credit card was the most successful credit card launch ever. Can you qualify that for us with some numbers?
Sure. I said that we believe it's the most successful credit card launch, co-branded credit card launch ever. And there are a couple of things that I'd look at and I'd talk about. The first is we can look and see all the past credit card launches over the first month, 6 months, year. What were the number of cards that came in, and then we can look at the number of cards we have, and we're ahead of the pace of all of those.
How many?
I'm not going to give you that piece of information at this point in time, but I appreciate your asking. Second, we can look at the credit formation and how people are using the card, and what I'd say all the early data indicates that people really like the card. In fact, you and I were sitting here having a conversation, and you were telling me how much you like the card and how it was changing your behavior.
Not sure that was on the record, David, but sure.
Okay. But I like the fact that
not going to reveal what you said beforehand. Lucky you.
I like the card. And the next thing is when we look at the credit quality that's coming in, the credit quality it's an aspirational card, and the credit quality is coming in quite good. So over time, we will obviously give more data. We're only less than 2 months into it, but all the data that we see is actually doing quite well compared to the data we have available from other launches.
Is this, and Marcus, the tip of the iceberg thus far in terms of your disruption of consumer banking? Or you're halfway through?
I think we're in the early stages of building a digital platform for consumers that gives them more information, more tools at their disposal. We were talking a little bit about the data set inside that Apple Card. When you look at your phone, how much information you have. I think this is all version 1.0. And I think regardless of Goldman Sachs or who is ever doing it, the quality of the information, the data, the ability to manipulate it, that financial consumers are going to have going forward is just going to be highly improved. And this is early stage of that.
Let's talk about some macro. Has corporate optimism been damaged severely by the trade war?
I think that I think there's no question that a combination of macro factors has had an impact on sentiment. Whether it's trade, whether it's Brexit, whether it's a little bit more uncertain geopolitical environment, I think there's no question that it's having an impact on sentiment. On the other hand, the overall nature of global growth, while a little bit decelerated from a year ago, is still okay, still solid. And in the context of that, if some of these issues, if we got a trade deal, if we in some way, shape, or form did make progress on Brexit, and there was a Brexit deal here, I think that could swing the sentiment back, quite quickly. But there's no question when I talk to CEOs, they're a little bit more concerned or agitated about the noise, but are trying to stay focused on the substance.
In terms of the Fed, we saw the spike in the repo rate recently. Was that due to post-crisis liquidity capital rules that restricted you as banks' ability to stabilize the market? Or?
Well, there's no question that the regulatory construct had an impact on the available liquidity at that point in time. It was definitely a contributing factor. I know the regulators are focused on that and spending time on that. And like a lot of other things that regulators are taking a closer look at now that we're kind of 10 years past the crisis. This is something I think that deserves a little bit of focus.
In terms of whether or not the Fed should keep cutting, you said of late on a podcast internally that negative rates are a failed experiment. So do you hope they don't go anywhere near that level, or are we already low enough?
I continue to think there'll be consequences, in the long term for negative rates as an experiment. I certainly hope in the U.S. there's never a consideration of negative rate policy here in the U.S. I think it's interesting to see where we are in the economic cycle, where we are from a job perspective, and just balance the policy that we have today. Personally, I'm not a Fed governor, but personally I've been surprised still by the amount of monetary policy or kind of the low rate environment that we still have at this point in the cycle. I would have expected something slightly different, but we'll have to watch and see as we run through the cycle as to where that all goes. But negative rates are not something that I think when we look back on history and write the book on that, I'm not sure that'll be a good chapter.
You mentioned Brexit. Boris Johnson has a deal with the EU. He now needs to get it passed domestically from Parliament. How big a difference does that make to Goldman Sachs in London if he gets that deal passed and we have an orderly Brexit?
Well, we're very committed to London, but we're also committed to the continent. And we've spent a lot of time, both for ourselves and for our clients, really thinking about making sure under any scenario we're prepared to operate seamlessly, and we feel good about that. There's obviously been an enormous amount of uncertainty around this issue for a long time, and so I'm encouraged that it sounds like there's a deal. I understand the vote is still, unclear as to exactly how the vote will play out, but I'm hopeful that the vote will carry, and this would be good to get some of this uncertainty removed and for everybody to move forward. I think it would be a good outcome, a positive outcome.
Let's talk about WeWork. In your recent earnings, you lowered the valuation you carry your investment in WeWork in your books from $150 million down to $70 million, over 50% write down. What level of valuation does that leave WeWork at the top level for the company?
We're not going to disclose, how we mark our individual positions, but obviously that was an investment we made a number of years ago at a lower valuation. Over time, as the company was running processes and setting prices for liquidity, we, along with a number of other investors, took some liquidity in that investment, but we still have we still have an investment that's left. I think Stephen Scher, our CFO, said on the earnings call that at the current mark, even if it went down from here, we still have a profit in the remaining position. But we're watching that situation like everybody else, and it'll be interesting to see as they refocus the business how that business moves forward. But there is a real business that underlies that.
How do you think about the conflict of interest that you have a direct private investment in the company? You're also responsible for marketing, or were responsible for marketing the IPO to new public market investors. You want a high valuation based on your direct investment and versus a legitimate valuation for new public market investors. How do you weigh that conflict of interest internally?
Well, we've been an investor for years and years and years, and we've got a lot of experience in managing the fact that we have a broad investment portfolio, both for clients and for ourselves, and that we're in the capital markets. In the context of this situation, this was an investment that was made at the very, very early stage of the company. Of course, we want that investment to do well, but at the same point in time, we have a duty to investors as an intermediary to price IPOs so they work in the market, and those are two separate parts of the business, and we've always operated successfully through that.
Sure, and I know both of those types of business have gone on for a long while, but I guess this is a very high-profile example of where that all broke down. The S1 that was filed...
I'm not so sure that it broke down. Why do you say that it broke down?
Well, the IPO went away.
Oh, the IPO broke down. I'm sorry. I thought you were talking about the process.
Well, let me put it this way. This S1, of which you were the lead underwriter on and a co-lead underwriter and signed off on the S1, had the founder owning buildings where the company was a tenant, the founder taking multiple personal loans from the company at very low rates, the founder charging for the use of the name We, all male board directors, dual-class share structure that many people have questioned. You, I know, care a lot about corporate governance, and yet you endorsed this S1 and a high valuation, which if invested had gone for, you would have sort of approved it in one sense, whilst also being a private market investor. Do you think there are no conflicts of interest there whatsoever, and are you happy with how that all played out?
Well, there are always conflicts of interest for an organization like ours, and we do our best to make sure we're transparent where those conflicts exist. With respect to this particular situation, I think what's unfortunate about this, and I think it's a little bit of an adjustment, broadly speaking, with respect to the IPO process, there's been a lot of focus on growth at all costs. I think the IPO market is pivoting and getting much more focused again on growth with a path to profitability. I think as there's been focus on growth at all costs, there's been a more lax approach than I personally think's appropriate around governance, and I think that's getting corrected a little bit. And so even though this played out publicly, I do think that the process ultimately brought the company to a place where it may or may not would have been public, but the process, which was feedback from investors, feedback from banks, including ourselves, basically said this won't work unless you get it to a different valuation, different governance. Some of the things that you mentioned were changed through the IPO process and would have been different if the company had gone public. And the public never saw the valuation that the banks and the underwriters were telling the company we thought the valuation had to be in order to actually go public. So it played out a little bit more publicly than that process you'd normally like it to play out. But I think at the end of the day, the market process worked.
So moving forward, perhaps, the lessons learned from this, whether it was with Uber before it as well, which had some corporate governance issues which played out publicly, do you think that you guys across the board in the investment banking space should work earlier with these companies to get rid of those corporate governance question marks so that they don't come up again?
Well, look, our job is not to be the rule maker for what the public markets accept or don't accept in terms of governance, value, et cetera. It is our job to try to suggest over time what we think makes sense for investors and for markets broadly. And so that process will continue. We'll try to play our role in that process. But ultimately, the market makes judgments around these things as to what's appropriate, what's not. If you go back 20 years ago, there weren't a lot of high super voting stocks. And today, for a lot of these founder companies, there are. And in fact, there have been a lot of people that have advocated that there's benefit to that. You know, we'll see over time whether or not the market changes its view, but that's an evolutionary process. And our job in that process is to bring buyers and sellers, or the companies and the investors, together in an appropriate balanced process, and we'll continue to do that.
I want to switch focus and talk about some of the other strategy changes, most notably the shrinking number of partners at the bank. That's got quite a lot of attention in the press of late. Talk us through what's going on there.
Well, I joined Goldman Sachs in 1999 as a partner, and so I have 20 years experience watching the natural process of the Goldman Sachs partnership evolving cycle to cycle. We run 2-year partnership cycles, as you are aware, and I naturally have watched that over time. And what's interesting is I can go back, 18 years ago, I can go back 15 years ago, I can go back 5 years ago. The process right now looks no different than it's looked in any other cycle. I know it's getting a lot of visibility right now. I think part of that might be because we've had a leadership transition in the firm, and so at a time of a leadership transition, there's a little bit more focus, but there's no change in that evolution. And part of the culture of the partnership is to constantly be giving younger people in the partnership opportunities to step up and have bigger jobs, and that natural process is going on over the course of the last cycle.
David, as we wrap things up here, we're coming up to the 150-year anniversary of the founding of Goldman Sachs, which you mentioned yourself at the top of the interview. What does that milestone mean to you, and are you proud to be the leader of the firm as it crosses that milestone?
Well, this year has been the 150th anniversary, and we've tried with clients around the globe to celebrate and commemorate that history. I'm humbled and proud to have the opportunity to lead the firm at this moment, and the event of the 150th really reminds you that this has been a very versatile firm. It's been a nimble organization that over a very long period of time has found a way to add value, survive, and thrive. And so I view my job and the leadership team's job, all of us, the partnership of the organization, our job is to continue to carry that legacy forward. And it's a big responsibility, but we're excited about the opportunities we see and excited about our ability to serve our clients in an ever-changing world.
David, it's always a pleasure to sit down with you. Thank you for your time.
Absolutely.